Good evening and a warm welcome here to our next webinar at JFD Bank. Today with the topic mean reversion trading strategies or strategy. Anyhow, my name Stefan Friedrichowski, as always, for those kind of webinars, and warm welcome in my name as well. Yeah, today is the 18th of April 2019, and it's a pleasure for me to have you all here. I think, some new names as well. Wherever you are, it's good to have you here within that webinar. You see already our title, Mean Reversion Trading Strategy. So yeah, that's really a base or even basic strategy we want to discuss today. And it's even a little bit more than just discussing the basic principles of strategy. As always for my webinars, I not only want to give you some hints of how to trade and give you a complete and ready to trade recipe what to do. Especially today, it's much more because I want to show you how to develop something like that and how to ask steps even before you open the first trade. That means, do we have a statistical edge? Do we have a probability advantage if we do what we are doing or intend to do? And so it's much more than just to say, okay, if that, then open trade, take profit, stop loss. And no, it's much more behind the story, that kind of story. And I want to introduce those kind of concepts as well, and that you can learn a little bit of how I personally develop trading strategies and finally come to conclusions about special strategies itself. As you see, oh no, I forgot something. Sorry for that. I forgot even to give you already access to my slides. Sorry for that. I will do it as we speak here because you should have those slides if you like. And finally, what I can tell you already later, we will have some additional Excel sheets. And if you have interest in those, just send me a note. Unfortunately, those I cannot upload here directly. Therefore, I can only go via email. So you see my email address already here, s.friedrichowski, it's a really complicated last name, at jfdbank.com. But anyhow, if you just send an email to support at jfdbank.com, it will finally reach me. Definitely. And I will make sure that you get the slides or the Excel sheets later shown. Okay. You know that I have always to show once during a webinar that kind of slide or with disclaimer, because we are talking about trading strategies, and later you may adapt those ideas, but of course, finally, whatever you do it on your own responsibility. I think that's self-explaining, and you understand that I have to mention that as well. Okay, having done that, let's go to the topics of today. First of all, of course, I have to talk about the basic principles of mean reversion. It's really a mighty tool for any trading activities. And even if we later talk about full automatic trading possibilities with that kind of approach, you can use what you will learn here, even for discretionary trading directly out of the chart, because you can use exactly the same logic direct. And I'm quite sure that you will have some good trades with that basic logic about mean reversion. You will learn a little bit about what we talk about fair prices, fair values, and how to use them. But let's go for that later. But if you have such an idea of that we go for mean reversion, which is more or less going back to a fair value. If you have such an idea for any trading strategy or trading approach, the first thing you need to do is you need a proof that you generate with that kind of approach what's called an edge, or in other words, a probability advantage. I think edge stems from poker, but I'm not really sure. But so probability advantage may be another word for that. So we have to be sure that this kind of approach, that kind of entry signal, really generates an edge. And because only if you have such an edge, such a probability advantage, it's worth to go further into the complete setup of that kind of strategy. Without that, we are lost, because then we don't have to go further. Then I will show you up a strategy going with mean reversion, even without stop loss, and you think, oops, Stefan goes without stop loss. Normally he's always telling us we need a stop loss. Yes, the story is right. Sometimes I have a few exceptions out of that rule, and I can explain why I have those exceptions. One, for example, is if you are talking about trading stocks. Okay, I know that beyond zero, no stocks can fall down. So yeah, I know exactly what I'm doing. Then that is an example of having no stop loss. Or at least if we don't have huge trades. So and we have what we later will introduce, time stops, meaning that our trade has definitely an end, and that will be either end of the day or end of the week. So that gives a limit as well. And finally, what we are doing is, of course, we will look for a complete scenario, complete portfolio of forex pairs, as well as, I think finally we have some indices as well in the loop. And yeah, so that you will see as a complete portfolio. So, but let's start with the very beginning of mean reversion, because that is already quite important to understand. And the basic assumption of mean reversion strategies is that there is something what we will call a fair value for a given underlying, whatever that underlying is. And to have that kind of fair value for a given underlying is a basic idea. Then the actual price, if we look to the chart, might deviate from that fair value. And since I call it already fair values, you imagine already the idea. If we have huge deviations compared to that fair value, then the natural tendency is that the price goes back to exactly that fair value. So whenever we have those kind of exaggerations, so if we are far from that fair value, we have the idea the price goes back exactly to that value. And that's all. That's the basic idea of mean reversion. But obviously there's a big question mark, and that is, what is a fair value? So how can we define a fair value for any given underlying? For example, if I talk about DAX, DAX might be at 12,000 points, and for whatever reason, I call 11,000 the fair value. What we would do then is obvious. We would open a short trade into the direction of that fair value. And if the actual price would be 10,000 and the fair value is 11, then we would open a long trade. That's easy. But how to define a fair value? And let's be practical here. Let's be pragmatic. We just define something as being the fair value. And one example or one possibility is we just go for an EMA within our chart and we call the EMA value the fair value. Why not? So I don't have a real logical definition or something like I can tell you, yeah, that's the reason why you have to calculate the fair value exactly that way. No, we just call the EMA the fair value. And then of course, we will do the next step, and that is looking whether that has a probability edge, probability advantage, so a so-called edge. And if so, then don't care about the real definition, what is really fair. Other possibilities might be to use regression lines within the chart, and or you take values even from higher time frames. Maybe close of last week, that is a fair value for the next week, whatever. Everything is possible. To illustrate that basic idea a little bit more, let's go for a chart first time here. I have to mention that I have done a similar webinar, well, not really similar, but at least it was titled Mean Reversion almost 2 years ago, and that's where I took that picture here. But it's still valid, so I go exactly for the same picture. And what you see here is a chart, a standard chart. In this case, it's M15. Later, we will use H1 or even M5 data, but it doesn't matter for the principle of that kind of strategy. We have the chart, we have the candles, we have an EMA value, an EMA line within that. Maybe that was 50 EMA. I don't know exactly. But let's go exactly in the middle. So you see already everything you need to know about that strategy, about the principle. Here, of course, we have huge deviation from that EMA. And if we see here that huge deviation and we follow that logic, we open a trade into the direction of the fair value, and the fair value is the red line, then we would open a short trade, and doesn't look that bad. Another example here, doesn't look that bad. Even on the other side. So now we are on the south side of the fair value. Opening a long trade here doesn't look that bad. You find typical examples. But I have always to mention, if a speaker about trading idea uses a chart, of course, he will confirm his idea within that chart. That's how to select the appropriate chart segment, as always. But we will do a statistical analysis of that, and if we can prove it there, then it's much better than just to have a single chart which confirms that basic idea. But that's how we go. We have to talk about some details. What could be the take profit level? Will it be the moving EMA value, or should we fix it? Do we use a stop loss? All those things we have to define. But one step after the other. Now, the trading setup itself is therefore quite easy. The trading setup just has an EMA period. So we use an EMA, and that EMA needs a period. And in principle, that is a degree of freedom, or that's more the mathematical wording, or we just call it a parameter. So we can turn that knob. So the EMA period. Then we just measure something, and what we measure is the distance. I should call it better, not here already threshold. It should be called distance. What we measure is a distance between, the distance between the EMA and the actual price. What we are doing here is we simply subtract close price minus EMA value and take the absolute of that, so that we have a real distance. And in order to have it on a percentage level, we divide that by the close price. So then we have let's call it a universal distance in percent. And later we will ask whether that distance is exceeding a certain threshold, and that might trigger a trade. Okay, got it. So second degree of freedom now. First, EMA period. Second, that threshold. We need to define that. Let's see. We might have a third one, which is just a stop loss in percent. Maybe 1%, 0.5%, whatever number. So already that kind of description is quite good, because we only have 3 degrees of freedom, even if we include a stop loss. If we don't use a stop loss, we would even only have 2. That's cool. Okay, so the trade is opened if the threshold is exceeded by the close price. So we look for the close of a given candle, we compare to the EMA, and if that distance is far enough, then we open the trade. Perfect. Opening well defined. When is the trade closed? Okay, if we reach a stop loss, if we apply a stop loss, then of course the trade is closed. But we can define a take profit. So one idea would be we'll go for the EMA value at the open of our trade. Later you will see that we have 2 possibilities. So we can go for that we write down the EMA value at the open of our trade, or we just take the EMA as it is. So sometimes then our take profit will come closer to us naturally, because EMA is following always the price with a certain lag. So whenever we cross either the one or the other, both are valid variants of that kind of strategy, then we close the trade and we say we have reached our take profit level. So that's everything we have to do in order to define that kind of strategy. I want to use an additional stop, which I always call time stop. And that is just the end of the day or the end of the week. There's a specific reason for doing something like that. The end of the day actually would be even a little 1 hour earlier. You may know that at 11 p.m. Then always the so-called swap costs are accumulated and are charged to your trade. So the financing costs are charged to your trade. We can avoid that if we close the trade before. And the other thing, going, for example, for end of the week, that would avoid any gap which might occur over the weekend. So we don't have that gap risk. As long as we are trading instruments which have prices 24 hours during the normal working days, then we don't have a real gap risk for those symbols during the week. But if you would trade at other brokers, or if you trade symbols which follow exactly the future of the DAX, for example, then you have non-trading hours between 10 and 8 o'clock in the morning. So 10 o'clock in the evening and 8 o'clock in the morning. In order to avoid any gaps, any non-trading hours, it's definitely a good idea to have that kind of time stop involved. Let's go at least one time here within a chart. And let me open, for example, Australian dollar, US dollar. Yeah, let's go for that as an example. Let me enlarge the picture. Let's go for H1, for example, and let me enlarge it once again. Now we can once again check our idea or our strategy. And let me go here in the middle of the chart as well and repeat a little bit of the logic of that kind of strategy. So we always measure the distance between close of a candle with respect to the EMA at the same time. And if that's the story, if that would exceed a certain level, then it's time to open the trade into the direction of our EMA. Let's assume we would reach that stop loss here with that candle. So we would open the trade exactly here. You saw that I moved to the next candle. So I wait until the end of that candle. I can make my decision. So trade opening would be actually the open of the next candle. So we would open the trade here at that level. That would be our open price for that mean reversion trade. And now let me explain within the chart the 2 ideas of where to set the take profit. So one idea is we go for the EMA value at the open of the trade. And that would be, oh, that's exactly here where I opened the sell trade. But anyhow, I go here. So that would be the take profit level for that trade. Variant 1. Variant 2, it would be a moving take profit. It would be a moving take profit in the sense the take profit would be the red line, and whenever we cross the red line, we would close the trade. That's the other idea. But let's start with a simpler one, and that is the one that we have a take profit level already from the very beginning at a fixed level. You see what happens here. So we open the trade here, and a couple of hours later, in this case, it would take for the next day, here we would hit our take profit level. Perfect. Second confirmation. So second chart was a confirmation of a good trade. But nevertheless, that's not a statistic. It's just a statistic 1 or 2, but that's not something we can take as a proof. But that's the basic idea of those kind of trades. I hope you understand the logic and you can follow. And doing it that way, even with an unsharp definition of what distance level we should take in order to open those trades, you see, it doesn't look that bad. So if I would have opened the trade already here, okay, I would reach my take profit as well. Or you see, exactly for those kind of conditions, if we don't have a move strongly in one direction, it's a perfect strategy. So the strategy is even more profitable in what we call sideward markets, and 70% of all time we are acting in sideward markets. So it's a good idea to have that strategy within your overall trading portfolio. So that's the overall logic. But up to now, we don't have any proof for any edge. We don't know, only from a few examples within the chart. Doesn't look that bad. But that's not how I introduce or develop trading strategies. So now it comes to that kind of proof, or to answer the question, do we have an edge? And I want to show you how, from a more methodology point of view, how I do such kind of investigations in order to confirm that edge. So I will do an investigation, and the real investigation, by the way, is done with self-written C++ code and programs. And if you are a little bit longer already with my webinars, you will realize, hey, Stefan mentioned C++. Yes, I have changed the language from C to C++, but anyhow, I did that step. So the investigation I have done in order to prove that a kind of edge has been on M5 data, so with more than 15 years history, which is more than 1 million candles per pair. So, and I investigated originally 29 forex pairs, so everything you can create or combine out of those 8 currencies. And finally, the 29th is gold, which for me personally acts like another forex pair, but anyhow. So the amount of data I have investigated has been quite huge. And even more, what I did, first step, and you will later see why, I opened it with every M5 candle such a trade into the direction of the EMA, even not asking what distance do I exceed already any threshold. I will do that in a second step. The question about the threshold we will do in a second step. So first thing is, in order to prove the kind of edge, with every new open of a M5 candle, I open a new trade. And even not waiting until the trade before comes to an end. No. So it will be millions of trades. We will, in principle, investigate in order to prove that kind of edge. So trade, as introduced with the strategy itself, is closed by crossing the EMA, and EMA I always mean the open, the EMA value at the open of that trade. The other variant I have not investigated up to now. Still, I used that time stop at end of the day or end of the week because I don't want to have that long-lasting trades. If we start exactly in that way, then we can now look what distances, those distances from our EMA value, are most profitable, because we can look from that perspective. And we even start, just in order to investigate that edge, we will even start by trades without costs, meaning no spread, no commission. We will investigate that as well, but that's more a principal kind of approach. When it only comes to the question of do we have an edge, we can disregard costs and first prove that. The next step then will be, is our edge good enough even to be better than having those costs of trade involved as well? But that's then the next step. Let me show you some results of that kind of investigations of millions of trades, and then you will learn how I can prove that kind of edge. You see now an Excel sheet, and I just start only with two symbols in order to show you how those kind of results have been created. You remember, we know always at the open of the trade the distance to the EMA. Okay, that means we can classify our trades. So I can ask for those in total 1 million trades I have executed. When I opened a given trade, is that distance within that interval between 0% away from, so exactly on the EMA, or 0.01% away from that EMA. So we can ask, is our actual distance in that kind of interval? And if so, then that trade will fall in that distance level. And what I can tell you, for all Australian dollar and New Zealand dollar trades, I have earned in total 725 euros with those trades, which fall into that distance interval. And on the other hand, with gold, I would have lost 750 euro. So that's the logic of that kind of table here. So between 0.03 and 0.05% distance, we have earned 4,662 euros. And that's exactly what that blue line is showing you. So what does it tell you? Okay, we learn that we become we get the most money with trades in the distance in the region of 0.07. That's the maximum here. That's, for example, one lesson we learn here. And we learn the other lesson, that if we go for higher distances, okay, maybe there will be less trades and the total profit is not that huge. The other thing you see already with the two examples, Australian dollar, New Zealand dollar, it works well. For gold, no. More or less, no. I took that example first with just only two symbols because, of course, I have investigated all the other ones as well. But you now see how the concept looks like. We always get that kind of bell-shaped curve here, and there are underlyings which work better than others. Okay, let me simply accumulate all those trades, because then I know the total profit of everything, and that is what I show up here. Let's have a closer look to that kind of sequence. So what you can see is the best symbol at all for that kind of approach would be British pound, New Zealand dollar. Second, New Zealand dollar, Canadian dollar. You realize those kind of instruments? Although already in other webinars I called those underlyings the more boring one. Let's move to completely other side. Here we have euro, Japanese yen, gold, US dollar, Japanese yen, Canadian dollar, Japanese yen. You see yens. Okay, we labeled already in former webinars those kind of instruments the more trendy ones. But here we need mean reversion coming back. Yeah, that doesn't sound like trend or trendy behavior. Okay, that gives us already a hint which symbols are good for that kind of strategy and which symbols are maybe not that good. So that's one thing we have done. So it looks already not that bad for our strategy. And now it comes the next question. So in principle, it might work, but what about the costs? Let's already foresee a little bit what will happen. So you see, most of the profits here will be generated with very small distances to the EMA. So that means those trades don't have huge profits because the individual trade is just a small trade. And then we realize that we go more for the minor pairs. Not typically those have higher spreads, so higher costs. That might be critical for us, that we, even having an edge, that we after costs will still have an edge. So of course, it's really important for this kind of approach that we will look into the costs as well. So let's go for that. So involving the costs is quite easy. We have all the information we need for that, and therefore we just have to recalculate all the trades, including all the costs. Let's do it. So then let's go with cost. Once again, in this case, I have 3 examples. The principle of how to present the data is absolutely the same. I once again go for the distance intervals here, like, let me move the chart a little bit away, or even further. So we go for those distance intervals from 0 to 0.01, from 0.01 to 0.02, and then we can see where we earn money. And of course, you see, in costs included, the very small distances now generate huge losses. Simple reason, because our gross profit is less than the costs of trading, because we don't have long distance trades, so to say, and therefore they are in principle profitable, but after cost not anymore. Therefore everything goes extremely to the south for very small distances. For gold, now it's completely lost, so gold will not be a symbol for that kind of strategy. But you see already 2 examples, and they work. That's good. So you can already think about how to generate a strategy out of that. Definitely, we need a minimum distance in order to open any trade. To open a trade with very small distances from our EMA will not give us profits. But what about if we start, for example, here for the red one, New Zealand dollar, Canadian dollar. If we start at 0.2 distance, then we get everything above here. Or maybe we can go even starting here at 0.1, because then everything which is above that level would be profitable trades. Hey, that's cool. So we just need that kind of threshold, and we can easily define that threshold here. So let's go exactly from the other side. So let's ask, okay, if we only go for trades above, for example, 1.8, then we would earn everything which is here above. That would be still close to zero, and so on and so forth. And that's what I have done. And then you get those lines. So I accumulate all trades above 1%, 0.8%, and then you would earn this one. 0.6, then you would earn this one. 0.4, then you would earn this one. 0.2, this. And now you see, okay, starting at 0.1 will only generate me profits. And I will go for everything from there onwards. And even we might think here we don't have that kind of example that we don't trade anymore if we exceed a certain level. Okay, but definitely we need that minimum distance level in order to have profitable trades finally. Doing so generates not the best, not quite bad curves. To have everything here, there we are. Now here we have still all the symbols in, and you see, okay, there are a lot of curves above zero line, which means we get profits. And even although it's just a brief view on that, that is everything still. We close all the trades before end of the day, or at 11 p.m. or 1 second before that. We can get a little bit more out of the kind of strategy. Let me show you that example as well. If we wait at least until the end of the week, so in total we would earn even more money here, and you see more lines above zero within that one here. I know we cannot identify everything directly, but it should illustrate that we can realize out of those bell-shaped curves that we just need a minimum threshold which should be exceeded for a given symbol, and then we can generate profits out of that basic idea. Okay, that sounds like a confirmation of an edge. And even after costs, we still can realize that we have such an edge. But now, remember what I have done? I have traded every M5 candle. Okay, now we have learned we need a minimum distance from that EMA, in order to open the trade. Okay, but would you still open those trades one after the other? So that's what I have done in that kind of investigation. So I don't have single trades. No, I have lots of trades. Let me go back here to that chart. Think about my threshold for the distance level would be in the order of, let's say, five grids here. Then I would have opened the first trade at the end of that candle. Then I would have opened another trade here, another trade here, another trade here, and so on. And maybe later here, the distance is not anymore exceeding my threshold. Here, I would not have opened an additional trade. In that kind of simulation I've done. Think about practical trading. Okay, we would open a trade and then wait. We would simply wait for that trade come to an end. Either stop loss, or we cross our EMA, or we reach our time stop. So it would be more a single trade strategy and not trade bundle, opening one trade after the other if we still exceed our threshold. Nobody would do that, at least not manually. With an expert advisor, of course, we can do, but still each new trade would give additional risk to our overall account. Therefore, let's rethink about that. If it comes to the real strategy, we want to have one trade after the other and not millions of trades. Okay, we can do that kind of investigation as well, no problem. So what we will do as a next step is from that edge to the strategy. Now as I introduced already, we will not trade anymore all M5 candles, even exceeding that threshold. So if you have an open trade, we will wait until that trade is closed. Okay, but now we get less trades. The number of trades will go down, of course. But now what we can do in the next step is we can really look for those lower and upper limits for our threshold in order to achieve the most profitable trading strategies with that single trade approach. And if it still will work, okay, maybe not for every symbol. As we learned already, there are symbols which are more suitable for that strategy than others. Perfect. We don't have to trade every symbol or any symbol. Let's do a selection for that strategy. Why not? Still, in the following, I will close our trades at before weekend as being the time stop. And now I will investigate additionally even some indices like DAX and S&P 500. So those have been included as well. I will directly jump to the final result so that you have an idea what does it mean to have that kind of approach. And let me even enlarge it one step more. I will explain you first just one single line, and then you will understand what's all about within that Excel sheet. Let's go for the first line. So obviously it's the symbol Australian dollar, Canadian dollar. And I have investigated the EMA 10. And you see already later, I went through the universe of EMAs, but very rough, with steps like from 10 to 20 to 50 to 100, even further down here up to 5,000 in my M5 chart. So I have investigated a couple of different EMA periods. And then I looked for the best strategy within some threshold limits, minimum and maximum value. Sometimes those are even close to each other. Sometimes we have values like here, for example, that we would trade from 1% up to 2%. And all those trades we would take. You see the number of trades being executed during the last about 15 years. And then the other numbers, like always when it comes to trading strategies, I have some key figures, and we don't have to go into those details. But one detail I want to mention. You can imagine that later we will combine those equities for different symbols to one single equity for portfolio. There's always a question of, okay, we can trade every strategy the same way, for example, with 0.01 lot. But whatever we do, we trade 0.01 lot. Okay, that's one thing. But maybe we can later scale some the sub strategies, the one more than the other. And then one possibility for that scaling process is to look for the same total euro maximum drawdown for a single strategy. Therefore, I have something like a scale factor. In principle, that factor should be an integer number, but I forgot to scale it down to an integer. But anyhow, it doesn't make a huge difference. So what do we learn from such a big table? Of course, I have done that investigation for more than 30 symbols and for in total 9 different EMA values. And you definitely will see, let's go for the final number here, Opti. Opti is a special key figure I use for trading strategies. For the moment, the only thing you have to know is the smaller the better. Not the higher the better, the smaller the better. So the best Australian dollar Canadian strategy would be this one, EMA 1000. Okay, then we would have the best results for that given symbol. You can see already there are other symbols like Australian dollar, Swiss franc, not that good. Only a few EMAs would work. And but on the other hand, if we go here, for example, there we have a special underlying as well, Euro Hungarian forint, which works very well for that strategy. Same is true for euro, Polish zloty, and we will see others. British pound, Canadian dollar is working, and very well New Zealand dollar, Canadian dollar, as we foresee already out of our edge investigation. Even DAX in this case has a symbol GRX euro. The reason for that specific symbol is the data source for those M5 DAX data. Yeah, now the next step is quite easy. I simply select all the good ones for a given symbol, and then I can create my portfolio. And that's exactly what I have done. And I can show you the result for that. Before we look through the equity, I know that's always the most interesting part, but here we are. Here we have the complete list of symbols which are most suitable for that kind of strategy. And you see, for example, New Zealand dollar, Canadian dollar should be traded with an EMA of 2000 and a minimum maximum value for the threshold. So the distance from that EMA to open a trade would be between 1.2 and 1.6%. That would trigger a trade. And if you have an open trade, we will not open another trade, but we will wait for the end of the trade, and that's the only thing we will do. The good thing is, okay, you can trade such a strategy by an expert advisor. That's the one thing. But you can use that kind of table here already just as a filter for good instruments if you will do those kind of trades discretionary. So look for those instruments. They work best with that kind of strategy. So, and therefore, as I mentioned, if you want to have all those Excel sheets, no problem, I will send you. Send me an email first, because otherwise I will not know to whom I have to send that. In overall, combining all those trades, that's a huge list of trades. Let me see how many trades have been executed over the last 15 years. That's 12,000 trades for those symbols in total. Yeah, not that bad with the equity, and 70,000 euros within that time frame. That's good. So that's a strategy without a stop loss. Oops, no stop loss, as I mentioned. But if you look for the most unprofitable trade within that table here, it's a couple of hundred euros. Okay, compared to 70,000 earnings, we can accept that. So even without a stop loss, it's not that bad. But we can introduce a stop loss as well, just as a percentage value. Then the story repeats. So I can show you the results for with stop loss as well. We get a new table here, but the logic is absolutely the same. You see different EMA values, and then besides that, we have minimum and maximum value for our distance thresholds. We have stop loss in percent here as well. Yeah, but that's all. So that's stop loss is set, and then we have a third condition, how to end the trade. Waiting for weekend, that's one thing. Crossing the EMA, the other one, which would mean we reach our take profit. Or third thing, we reach the stop loss. Okay, we can do that. And then we get a new list of best strategies. With the stop loss, we can get some more symbols which can be traded with that kind of approach. So that kind of table here is, so to say, more lines are filled with good numbers. And that actually we can see in a combined equity here as well. And first let me go for the list of symbols we can trade now. And you see, okay, that list is a little bit longer now. So we have more instruments which can be traded. And the combined equity of all those sub strategies is shown here. So it's a little bit more stable, so the drawdown is less if you would go for that mathematically. So that is something we get out of the stop loss. What you see here is, of course, mathematically driven. It's optimization, combination, but it's also a good example for how to create trading strategy. It's the methodology behind. You have an idea which should create an edge. First, we proved that edge, and then we thought about what if we introduce costs as well. And then we see we can create a setup and realize, hey, we need such a threshold value to open trades, yes or no. And that's a way how you can derive and develop trading strategies. I hope at least you got my point here, how to do those steps. Maybe you cannot redo everything by your own in the same detail with self-written programs, but I think you could catch up the clue of that. So overall, in a nutshell, mean reversion is really quite smart base or basic strategy. You can use that kind of an idea even with your discretionary trading, looking for huge deviations. And if you have those deviations, you trade back to to that fair value. And we just called it fair value, and we don't have really a clue what is the fair value of a given underlying at a given time. But in this case, we just use an EMA, and it turned out, why not? So it works. So that's good enough for us. So using that kind of idea for discretionary trading is good as well. But what you have learned, hopefully, during the webinar is also the kind of methodology I use here. So I first try to prove that edge, because if I would not do that step first, okay, I might get a trading strategy, but I don't have a clue why it works. So with proving that edge, we learn a little bit more why, and we learn how to improve. In this case, what we learned and what was essential is to have those kind of threshold levels for a given underlying. Finally, what we have done here is we have set up a complete portfolio, and you can have access to the detailed parameters if you like, and I will send you those Excel sheets with all those numbers. That's for today. I hope you enjoyed the webinar. And at least in Germany, we have 2 days off, Black Friday tomorrow, and on Monday we have Easter Monday. I know in Bulgaria, everything is right the same, but just 1 week shifted. So happy Easter already now, at least for those living in countries like Germany, it will be this weekend, and for other people, for example, in Bulgaria, it will be just 1 week later. I can already announce next webinar in May will once again be about stock trading with a quite simple strategy once again. It's easy to use, and it will be not that mathematically driven like today, so it will be a little bit easier. But anyhow, whatever you like. I like both easy ideas and mathematics behind. I go for both, and now I think have a good weekend and enjoy the day. Bye bye.